We start our third video. We are still in week 1. In the previous video, you remember, we built the foundations by trying to better understand what is behind the evolution of sales. We are now going to look at what is between the sales and the profit. And we need to look at one of the fundamental financial statements of any company, the profit and loss statement, or the income statement, or the statement of earnings. We have to get used to the fact that in accounting and finance, unfortunately, people are using different words for the same concept. We should also notice that many countries have a profit and loss statement, while some others have a loss and profit account. It might look like a joke, but it might also mean sometimes that in some countries, companies are in business to make profit, while in some others, they are in business to make losses. Perte profit. Perdidas y ganancias. How does a standard, simple profit and loss look like? We start from sales. Everything starts with sales in business. Minus operating expenses. And we get the earnings before interest and taxes, EBIT, or operating profit, or trading profit, or earnings from operations. Then we deduce financial cost and we add financial income, if any, and we add or deduct the exceptional items. From this very simple presentation, companies have always tried to better understand what is in the operating costs by classifying them. The first distinction is to separate the operating cost necessary to produce the goods and services that they sell from the other cost, selling and marketing cost, research and development, administrative cost, etc., which are not production or manufacturing cost. This is the most common presentation, and by the way, this is the one you find in the Grahamian case. More recently, some companies have adopted another classification by separating the cash expenses, the one which are followed by a real cash outflow, from the non-cash expenses, like depreciation, which are not followed by a cash outflow. And we get the EBITDA, E-B-I-D-T-A, which doesn't mean earnings before I trick the damn auditor, but earnings before interest, taxes, depreciation, and amortization. So EBITDA is the difference between all revenues and all expenses which one day or the other will be materialized by real cash inflows or cash outflows. To go from EBITDA to EBIT, we just deduct D&A, depreciation and amortization, and we get EBIT. Just a quick word on depreciation and amortization. They are in fact the same for two different names. Depreciation is used for tangible asset. You depreciate a plant, you depreciate a machine. Amortization is used for intangible asset, goodwill, patent, etc. You see that depreciation and amortization are special items. There is no bill for them, no payment, no cash. When you buy a machine, $15 million, if you depreciate it on a 5-year straight line, depreciation will be every year $3 million. And on these 5 years, you will have a $3 million change in EBIT, but in no case a cash outflow. What is a cash outflow is the purchase of the machine, $15 million at the beginning of the 5 years. So really depreciation is a non-cash expense. It's an expense, it's a cost, but which is not followed by a cash disbursement. In the remaining of our presentation on financial analysis, we'll use the first presentation as it is the most commonly used, the one with cost of sales, and as I've already said, This is the one shown in our case, Gremlin. So let's remember the structure of the P&L statement, the profit and loss. We start by sales or revenues, deduct the cost of sales, the cost of producing what I am selling, and we are getting the gross margin. Then by deducting the other costs, the other operating costs, which are not production costs, selling cost, administrative costs, etc., you get to the EBIT, the operating profit. And then by deducting interest and adding financial income and adding or deducting the exceptional items, you get the net profit. Let's now look at Gremlin over the last 3 years, 1996, 1997, 1998. Growth has been very strong, 53% per year on the average. We could expect the operating profit to grow at the same speed. It is unfortunately not the case. The operating profit has grown at 50%, but in 2 years, going from roughly 1.9 million to 2.8 million. Why has EBIT grown at a slower rate than sales? We have to investigate. First, cost of sales, which represented 43% of sales in 1996, represent now 54% of sales. The cost of producing what we are selling has very significantly increased. Video games are becoming more and more sophisticated. More and more functions are expected from the customers. This requires more work, more development time than the company has not been able to pass to the customers through price increase. This is probably due to the strong competitive environment. Moreover, the selling costs have gone from 11% of sales to 14% of sales in 2 years. Gremlin's market is no more local, not even regional or even national. It has become global, international, and the distribution cost and other selling costs have increased. The only satisfaction is the administrative cost, which have been well managed, probably thanks to some economies of scales, and went from 22% of sales to 14%. But globally, the operating costs have increased faster than sales, and the operating profit has not enjoyed the same growth than revenues. So far, our analysis has been very simple and rather poor intellectually. Nothing very smart in saying that when the sales go from 100 to 130, they grow by 30%, and when the costs are growing fast, the profit won't grow drastically. We're going to try in the next 2 videos to be a little bit more ambitious, a little bit more sophisticated in our approach, and to add a little bit of value by describing what is sometimes referred to as the scissor effect in video 4, and by introducing the break-even analysis in video 5. See you in a few moments.